Starboard Value was a little-known $3 billion hedge fund when it moved on Darden Restaurants in December 2013. The firm took a 5.5% stake and sought a drastic overhaul of the company, including the end of Olive Garden's unlimited breadsticks. What followed was a dramatic activist battle that saw the departure of Darden's CEO and its entire board. It was one of the strongest signals sent to companies that activist investors mean business. Starboard Value, which oversees more than $9 billion today, always has its sights set on new targets. This year, Starboard has aimed to shake up Tylenol maker Kenvue, Corvo, and Fluor. Joining me now at Invest is Jeff Smith, Starboard Value CEO and CIO. Jeff, good to see you. You don't do a lot of these, so I don't know how I got you to do one of these. I've actually never seen you in person. I've exchanged a lot of emails.
Yeah.
So.
Well, I was hoping if I got here, maybe you would give me some tips for my fantasy football team.
No, we could. We got the team. Now that team is sitting over there on the other side of the room.
Yeah, I'm not doing so well, so maybe you have a couple of suggestions.
I do. Look, before I can even get into some of your campaigns, I think the people have to understand why you do what you do. What motivates you to launch a campaign?
Wow. So I think it's just part of who I am. I mean, from my standpoint, I look at the world, everything I look at, I can't help it. And I've learned this about myself, that I need things to be more efficient. I need things to be run better. It doesn't matter where I am or what I'm looking at. I have to analyze the best way, the most efficient plan forward. If I'm driving on streets, I'm mapping out in my head the most efficient way to handle the lights and where I'm going to make the right turn on red to avoid getting caught at a light. Way back when I was dating my wife, before she was my wife, she made a bet with me living in Manhattan that we couldn't get back to our apartment without stopping at a light walking across Manhattan. And then, it looked like I was going to be in trouble. We got to an intersection, there was a red light, and then we went underground through the subway and up on the other side of the stairs. So from my standpoint, it's always thinking around corners, thinking differently, and trying to be more efficient.
This is in your soul, it sounds like.
It really is. So when we look at companies, it's not too different. It's trying to understand the inner workings of how a business works and whether it can be run better. Yeah.
How do you know what tactics to take?
I'm not sure that we always do know. So just to be fair about it, I think it's a combination of personalities and timing, seasonality. Proxy windows only open up once a year. So the most leverage any investor has is potentially nominating directors during a nominating window leading up to a potential annual or an annual meeting or potential proxy contest. So if you're a month before, 2 months before, 5 months before, 6 months before, your tactics can be different. What the stock is doing, your tactics can be different. The behavior of the company can change our tactics. It's a feel thing. It's a knowing people thing.
I've long thought this, but I think CEOs are scared of you. Like, what do you feel about that? Why would they be scared of you? I mean, you're trying to unlock value at a publicly traded company. What is so wrong with that?
Not all CEOs are scared of us. Some of my closest relationships are very successful CEOs, and there's amazing mutual respect that happens there. I think it's more a matter of whether a company is performing well or a company's not performing well. And most of what we do is based in human nature. So if you can imagine yourself being a CEO that has risen to the top of a company because you've been there a long time and then you become the CEO of a large company, but you've missed your numbers for every year for the last 4 years, and the stock price is trading at a 5-year low, and then an activist shows up, you probably are going to be rightfully insecure. Now imagine yourself as a CEO that you aren't insecure. Maybe you're in the same position, but you aren't insecure. You know your business really well. You're very secure in how good you are and how smart you are. And you have been thinking about, put it in two camps, you have been thinking about how you're going to transform the business and perform better. So the one that's been planful and is really thinking about how they're going to transform their business and how they're going to perform better, it's probably several steps ahead of us, but maybe the market doesn't know it yet. Those CEOs, when we come and we approach them, are not scared of us. Instead, they welcome us in and they want to have a good healthy debate about what's going to happen for the future of the business because they've been active thinkers about it. And they're saying, okay, well, I've been thinking about that, but what about this? And there's a great dialogue that happens. And many of their ideas may be great, and maybe we accelerate those ideas. But if you put it in the other camp and you're the CEO that's been struggling for 4 years and you don't have plans for how to change the business, you don't know what to do better, and nothing's really changing, you're probably going to be insecure about it. So I think it's in two different buckets, and we see that fairly quickly, right? So when we make an investment in a company, if the CEO welcomes us in and wants to have this open dialogue about high-level strategy and what can happen with the business and what can be done better, it's usually going to go in one direction. If instead you have a CEO that's kind of putting up the walls and pushing you aside, doesn't want to have a meeting.
Our strategy is right. Like we know all the answers. Yes,
it might go a different direction because, Einstein's definition of insanity is true, and so we believe you need to make some changes if things aren't going so well.
How do you think you've changed the CEO over the past 10 years? How do you think you've helped just redefine that position?
I think, and I didn't expect this, but I think that corporate America, it's not just the CEO, but corporate America has been more active than they were before we started. Let's go back more pre-Darden. You mentioned Darden. So pre-Darden, so that's now going back 15 plus years ago, I think corporate America was slower to make changes. And actually one of our early investors, a very large allocator, made an investment with us early on, and we were talking, and they said to me, Jeff, we're making an investment with you, not just because we love what you do, we do, and we love your process, and we think the returns are going to be good, but the amount of money we're investing with you is really small compared to the amount of money we have in the overall market. And we just believe that activism is going to make the overall market more efficient. And they were right. That's what's happened. So what's happened is the direct impact we have on companies is so big, but the indirect impact that all activists have had on the market and making the market more efficient has been pretty huge. Board members think about whether their company is performing poorly faster, and they will take action faster. CEOs, because of that, in order to save their job and do a better job, will act faster, will make changes faster than they would have done before. And I think that's good.
Do you still view, let's boil it down, let's say the Fortune 500. Are Fortune 500 companies still bloated cost-wise from your perspective?
Not all of them are. So I think there's plenty that are efficient and run well, and then there's always going to be a subset of any group that are not run as well as the best performers. And so the great aspect of being an activist investor is whether markets are higher or lower, or companies in general are more efficient or less efficient, there's always going to be those that are not doing as well as some of their peers. And our job is to find the companies that are not doing as well as their peers, but where there's no structural reason why they should be underperforming their peers. It's more management execution, and get involved and give them this push, this catalyst for them to think about how they can run their business better.
I've never got to ask you this, but I figured, why the hell not? I might as well ask you here at an event. Going back to Darden, like after that whole ordeal, I mean, I had never seen anything like that ever before, from the slide deck, from the whole overhaul of the board. After that was over, what did you think? Like, what was the next few months of your career in life like?
After it's over, as soon as the proxy contest
you just won everything. The board, you got the board, the company got somewhat turned around. What did you think?
Well, so immediately upon winning the contest and replacing the entire board, which is the only time it's ever been done for a Fortune 500 company, I don't think it'll be done again. It shouldn't have been done then. I mean, there should have been a settlement that was done beforehand, but the board didn't take any action. There was a lot of pressure. This was a seminal moment, if not the seminal moment in activism, in that there were no excuses. Darden was either going to be a really good story or not a good story, and there were people on both sides rooting for different things. And I felt that. So the governance community and activists and shareholders that wanted companies to be more efficient were heavily rooting for us to perform really well. And there was a whole group of people on the defense side as well as corporate executives that would have loved to see it not go well and to point to that and say, see, that didn't go so well, activists aren't great. So from my standpoint, we went into that boardroom. I still remember to this day the conversation I had. I became the chair of the board and standing in front of the board and saying to the board, okay, we did something here that's historic, but it's just the beginning. We have to execute. We have to perform. We have to do something great with this company. This is incredibly important for the future of the markets.
I think the first time I talked to you was on the day that you had hired Rob Lynch over at Papa John's, and it was a campaign that you did at Papa John's. You led as chair of Papa John's. Both of you got the business going in the right direction. Rob's now at Shake Shack?
Shake Shack, yeah.
Leading Shake Shack. Papa John's has been the news of late. A bungled deal process or whatever's going on there. Would you want to get back involved with Papa John's? Because after you left, something happened, Jeff. They just fell by the wayside.
I love Papa John's. Well, look, Yahoo has a warm place in my heart. I was on the board of Yahoo years ago. Papa John's has a warm place in my heart as well. We did some great things at Papa John's. We improved the business tremendously. We changed the perception around the brand. We introduced stuffed crust pizza for Papa John's. It's delicious. It's amazing.
It is good.
The papadillas.
But you also got Shaq on the board too, as well.
Yeah, look, Shaquille going on the board was fantastic for the brand, and he's a terrific person and super smart. So that was great as well. I love the company. I would never rule out getting back involved. I think there's a lot of opportunity at the company, but it has to be right for both people and it has to make sense.
All right, I want to take through some other companies. You were also involved, that we covered really closely here, in Salesforce. Now, Salesforce went through a period of time after you really got involved on trying to improve their profit margins, and they did. But now it looks like they're back out making big acquisitions. The profits have been a little under pressure. Concern about if AI will eat software. What do you think about that company?
Salesforce is great. Terrific company. I think they're going to be an AI beneficiary. They are still focused on their profit margins. So they report each quarter not only their revenue growth, but they report out on their profit margins. And Mark Benioff is pretty excited about the improvements that have happened. You know, when we got involved, we were talking about them improving their Rule of 40 score. So that's revenue growth plus profit margin. And the Rule of 40 score has improved materially. So they have done a really good job at managing the business. The performance has been much better from the beginning of our engagement to now. The multiple has come down. So it's not an execution issue. It's, as you mentioned, software in general has been more under pressure, especially value software, which are companies that aren't growing 20+%. They're growing double digits, but it's not as high as other people would want. So we feel really great about it and think it's a terrific position for us, and the company's going to do well.
Okay, next up, Kenvue just inked a deal with Kimberly-Clark, $48.7 billion. You were involved with Kenvue. Do you like that deal?
I love the deal. I absolutely love the deal. So Kenvue, we got involved in Kenvue, amazing brands, the best brands in consumer health. So Aveeno, Neutrogena, Band-Aid, Listerine, Sudafed, Motrin, and then Tylenol.
All the stuff in our closets.
And then Tylenol. And it's amazing. The brands are absolutely amazing. Kimberly-Clark, also amazing brands. Huggies, Kleenex, amazing brands. I think what people don't exactly understand about this combination, and I think they will. I think they're overly focused on what's going on with Tylenol and acetaminophen, but is that the org structures are similar. So actually both businesses are organized where they're run by geographic P&Ls. And to some degree, they're limited in their degrees of freedom because each one of those geographies has to have enough scale to be able to operate. So by merging these companies together, nothing's easy, but it's a fairly easy integration in that you're actually merging two org structures together that overlap beautifully, in that you can put more products, more brands in each geography. And by doing that, you get more scale advantages in each geography, and also gives you more degrees of freedom to be able to prune the portfolio and take out the smallest SKUs with the lowest volumes, or even the smallest brands. it's kind of a nuts and bolts piece of the inside baseball of how companies operate and what happens, but the fit together of Kimberly-Clark and Kenvue is probably better than people think it is. It's really a very good transaction.
Key to unlocking, I think, the ultimate value of that deal for Kimberly-Clark, though, how do they regain confidence or trust in Tylenol as a result of all these autism concerns?
Well, let's go back one more step, though. So the other thing that had to happen at Kenvue was an improvement in digital marketing and newer marketing, and Kimberly-Clark has also embarked on that transition, and they're further along than Kenvue was. So we're also expecting that they're going to be able to speed up our process at Kenvue, and combined there'll be a better marketing effort, especially for what should be the faster growing skin health and beauty brands. As it relates to acetaminophen and Tylenol, I don't know that there's a big change that we're seeing in brand trust as it relates to the actual sales. I mean, the business is fine. The business will be fine. This is a brand that's withstood other things that may have been even worse than this. And I think if you look at what's been put on the Kenvue website, there's a lot of information out there about why the company and many key opinion leaders and experts would say that Tylenol and acetaminophen is safe. So I think consumers know what they want to take and what they want to use in their closet or in their pantry or in their medicine cabinet, as you mentioned, and I think they feel comfortable with Tylenol.
How did you know that would be a good target? Like, what did you do? You assemble your team in a room and say, okay, Kenvue. Like, how'd you know? Like, how'd you know?
We throw some darts.
You said that, not me, all right? I didn't say that.
What we do is a few different things. For each industry, I mean, I kind of alluded to it before, but for each industry, we're looking at a spread of the different companies that participate in that industry. And we're focused on the ones that have lower margins and lower multiples, and trying to figure out if they deserve to have lower margins and lower multiples. You mentioned Darden before. When we first invested in Darden, their margins were worse than their peers and their multiple was worse than their peers. And then we looked at it and we said, that doesn't make any sense. Their actual assets are better. They have better brands. They should be a leader in restaurants. So we love that. And then when you look at Kenvue, their margins and their growth rate were lower than their peers, and their multiple were lower than their peers, but these are the best brands in the space. Doesn't make sense. There's no structural disadvantage. If anything, there should be a structural advantage. That's what gets us excited. And then when you layer on to that calls we might get from other people who own the stock who are frustrated, and then you look into it and you say, well, it was a spin-off from J&J, and I'm not sure the management team is exactly best suited to be able to create a lot of value for the company. You start to triangulate around an amazing opportunity.
What is misunderstood about activist investing?
I don't know. I think people are pretty excited about activist investing. You guys are talking about it leading up to this, how exciting it is. Activism is terrific. I mean, what we're doing is we're investing in companies. I run into people all the time. They love talking about activist investing. They throw out names. Oh, you should look at this company. This company's running terrible.
Yes, actually, yes.
Check this company. Give me another. I mean, there's suggestions that come all the time. Everybody loves when we get involved in a company where they're invested. So I think it's pretty well understood at this point. We make investments in companies that aren't performing all that well, and the secret behind it is the biggest impact we're having is we're lighting a fire under a management team to do more faster than they would have otherwise done. That's what's happening. We make an investment, and the management team, the day after we make that investment, I can promise you, they are getting together and they are going to do more than they would have done faster than they would have done.
These are pressure cooker situations that you put yourself into. Like, what's been the most stressful moment for you the past decade?
Oh, I don't know.
Do you have like one out of like 100?
I don't know that I have one off the top of my head. I mean, every day is stressful and fun all at the same time. I don't know that there's been anything that's been all too bad. Well, I mean, in terms of the macro stuff, I'll tell you, it wasn't so much micro. I mean, for me, well, just like anybody else, I mean, dealing with COVID was massively stressful. I mean, it was stressful for all of us. So trying to think about that as a portfolio manager and analyzing the impact for companies and society and, and learning how to work from home and being equipped and prepared to be able to work from home while you're cleaning your food that's getting delivered and you're concerned about your safety but worried about managing a portfolio, that was pretty stressful. I would say that was massively stressful, probably for everybody.
Maybe we can make this an annual tradition. Thank you for doing this. I appreciate it. And thank you for the kind words on Yahoo. We appreciate it.
Well, I just need a football pick next year. You got to give me a
we
player.
We got to get the team. Please
somebody.
escort Jeff over to the Yahoo Sports side. I mean, please. I mean, let's come on. He's just asking for Yahoo Fantasy sports tips. Jeff, thank you. I appreciate it, man.
Thank you.
Thank you so much. I appreciate it.